Hi everyone, welcome back to Be Rich. It's me, Vinod, recording from the studio. It is probably Friday by the time you're watching this video, but I'm recording this on Thursday because today, like I said on Instagram, I'm catching a train back to Bangalore. So I get to meet some of you on Saturday. So that is the plan. So I had to get this video done. So without wasting much time, I'll jump into the comments from the previous video, which is Wednesday's video. On Wednesday's video, I had a lot of you asking me about doing a video on AMD, Nvidia, the semiconductor business in US and Japan. So I've combined all those comments together and I'm saying, yes, I will drop a video on this on Saturday. We will look into the AMD MI300 and the MI400 roadmap. We'll look into the competition of Nvidia, and also we'll look at both the value investors lens and see if it is a hype or what is this behind all this or that. We'll also touch upon the US ASML and AMAT and SMCI. I think I did speak about this a bit, but I don't mind touching it again and bring it into focus. So that is what I'll try and do on Saturday. And Equity Atlas, sorry, I keep on saying Equitas, I don't know why. Equity Atlas, again, seems to be really exuberant in his comments. Please keep it to one and keep it brief. Kind of like spamming us, with multiple comments. Equity Atlas, it doesn't help. I know you want to get my attention. You have my attention with one comment, trust me. You don't need to put multiple comments and then put follow comments to those comments saying, hey, did you read my comment? Hey, I'm waiting for your reply. I will get to you. I promise one comment is more than sufficient. And you've asked me about pharma database you want me to build for you. Sure, I'll try and build you a pharma database. You want me to look at a bunch of other small companies, right, which are moonshot plays. Okay, you want to see if there's any value in this. But of course, we always have to keep in valuation in terms of value investor discipline. So I'll see and I'll study this. It will take me some time. I don't know when I'll come back to this because it's quite a chunk of work for me right now. So I'll have to look at the pipelines and see if there's a catalyst and who's behind all this. So it's going to take me some time. Equity Atlas is not going to happen overnight, but I'll try and keep this on the pipeline. Sujit, again, are you considering daily in US? Well, I don't do daily in the US. My usual investments in the American markets are usually monthly. I don't do the Tiffin coffee range on a daily basis in the American market because I don't see the need to do it on a daily market because it depends on your motivation. I'm in India right now, and what I need to do is focus on India right now because I plan to be in India, not move out of India for the foreseeable future. And whatever plays I'm making in the US is a hedge, against what's happening in India and globally, keeping a hedge. So that's where I'm looking at investing in the US. Your perspective should be very different if you're living in the US or you plan to go to the US soon and you need to start building a bigger portfolio there. And India is your hedge, against diversifying and keeping India as a hedge. Then India would be more like a monthly investment and daily focus should be on the US. So that is the way I would suggest you look at it and not to look at me and what I'm doing. It should be more focused on what you're doing. So I don't consider it daily. I do it more monthly. Unless an opportunity opens on a sudden basis, like today, something in the market crashes, like we saw the great Donald Trump announcement crash. So those opportunities, when they do open, you have to consider investing on those too. IB Shark 8339. Do more Indian content and videos. Yes, I do hear you, right? I know. I honestly feel I wish I could do more Indian content here, but today I've started the effort of doing Indian content on Instagram. So Abhishek, come and follow me on Instagram and we talk about Indian stocks there and what I'm doing on Tiffin Coffee range, bought today and all those other stuff, interesting things which are related to the Indian market. I'm going to try and focus over there because Anand wants me to focus on this. And value investing is universal, my friend. Whatever principles I'm talking about here, more than the companies, you should be focusing on what I'm trying to talk about, how I'm taking the approach. And you can apply it into Indian market or whatever you wish to, so wherever you are. So I do believe I'm bringing value to this video, though I'm not specifically talking about Indian stocks. I do feel your pain, but I'm really not bothered about, the drop in view count and subscriber not growing. Those are nice. it's nice metrics to have, but you can't rely on trying to score for 4s and 6s in every single over. I'm not playing T20 here. I'm playing a test match. I'm trying to do value investing, and I want to be with you guys for years to come. So it's okay. I don't mind as long as a few of you are finding some benefit from this. I'm more than happy to crank these out. And Anand does extensively talk about Indian equities in our sister Tamil channel, MoneyPechu, and you can definitely catch him there. And he offers a lot of insight on Indian stocks there, so you can catch him there. And he's got a Hindi channel also, Paisa Bolte, and we got Telugu, Malayalam. So we are all covered. This is the only space where we're not talking about Indian stocks, because I thought we can do, Anand especially felt that we should be talking about American stocks too. So I hope this helps. JS Rajan is asking, good UK companies. Yes, there are a lot of great UK companies. Unilever is most famous of them all. There in India is Hindustan Unilever. There is Unilever. GSK is one of them. I will try and do another video where I talk about them and discuss that in greater depth. So keep an eye out for that. I'll talk about UK stocks. But where we are sitting, we're seeing a lot of value in US and Japanese stocks. That's where we're finding a lot of value. The problem is UK is right now, UK is going through a transition phase. So we're not really looking at UK stocks. But Shashwat also did do a couple of UK stocks. You can check those older videos out where he had deep dived into them. But I will try and do some UK stocks, I promise. And Sati SP3221, drug price order impact. Well, you saw the impact already in the Indian market, where he's trying to equalize generic and patented drugs. He's trying to equalize it, Trump. So that is happening, and that's why you saw a massive push on some Indian pharma companies that are making generic drugs, because they stand to benefit from this. And same way, I'm sure when the US market opens, maybe we'll see a beating on some American pharmaceutical companies which are on the receiving end of this. And if those are companies you've been waiting for some time, it's a great opportunity to look and pick them up. Because whatever is said and done, end of the day, they're the ones who are doing the R&D, they're spending the money, making the drugs, and it's not so easy as just signing. These things will go into court, and American system is very different than just him dictating these things. So if you do see opportunities in these companies you've been waiting for, do look at them and pick them up. And Aline Moananji, I hope I say your name right, man. How to fund IBKR for global stocks? Well, it's very easy. If you're an Indian investor, the best way is to make sure you're LSR compliant, and you can transfer it through your HDFC account or ICICI, whichever bank which you have, and you can fund transfer. Maybe I should do and explain a video on this, but it's very simple. Maybe if there's enough of you who are on IBKR and you're finding transferring fund difficult, let me know, and maybe I'll do a video on that. Anyway, that said, I wanted to jump into today's video. Today's video was going to be about defensive dividend utility, how that could be a segment you should pay attention to, like pharma. Pharma is something I spoke about, how it is not really paid attention to. It is not as attractive as tech. It's not as flashy and fashionable. Same way, defensive dividend companies are also even worse than pharma. People find them very boring and they don't invest, look at them very gleefully. But at times like this, these defensive stocks are great, because my fearless compounders, sometimes the best thing to do, you can do in your portfolio, is not chase the noise, but to own some of these boring stuff, because they pay you. They pay you quarter after quarter, while the rest of the market is throwing tantrums. These defensive companies pay you dividend quarter after quarter, and that is great. And that is a sector which I wanted to dive in today, utility stocks. Defensive dividend paying machines, as they call them, are very great to hold in during market jitters. And if you're a long-term investor, building a stable income, cash flow coming from these kind of a base will help you sleep well in the night. And plus, it'll also give you a steady kind of a cash flow, which you can take and play in the market on your other tech stocks and AI stocks if you're looking at it. So let's quickly unpack. A utility company provides an essential service. Okay, think of it like gas, electricity, water, and whether it's booming or it's a bust, people still need to turn on their lights at their homes, and you still need to use water, and gas is required. So no matter what is happening, this is a pretty safe, recession-proof sector. And these companies operate in a regulated monopoly. They don't have like 10 competitors doing a price fight. Their profits are stable and they are known as beautiful dividend payers, meaning they keep on paying. So when growth stocks are crashing and interest rates are rising, utilities stocks really don't move anywhere much because they're not bothered. They're like the unbothered uncle, as they say, like me, at a family wedding, calm, reliable, always there, picking up the check. So why are they great? Well, they have predictable cash flows. They have decent dividend yields. Most of them pay between 3 to 5% dividends, and that is sometimes better than a FD, fixed deposit rate, even better than bond sometimes, depending on where the interest rate cycle is. Of course, 3 to 5% dividend. If you're an Indian and I'm talking these numbers to you, like, what are you saying? I'm talking about American market and American FDs, right? And low volatility. They don't shoot up and crash 40% in a quarter. They quietly just chug along, moving a little bit here and there. And the main thing is dividend history. Many of them have been paying 40, 50, even 100 years. They've been paying dividends steadily and surely. So you're not just buying a utility stock here. You're looking, what you should mainly look at is dividend yield. It should be above 3%. Payout ratio should be around 80%. So that means they can do sustained payouts. And low to moderate debt. Lower the debt, the better it is. But debt is required for infrastructure. So don't assume you find these zero debt companies here. And dividend growth history. If they're paying dividend year after year, great. And if it's increasing, even better. So now let's talk about the companies, which some of 5 or 6 which I want to pull out as examples. And then I'll talk about in terms of where they are. Of course, there are some downsides to these companies, this whole sector, that is, they are interest rate sensitive. That means Fed increasing the interest rate, bond rate interest increases. The dividend doesn't look so great anymore, and investors usually dump them and go to bond. This happens with utility companies. They're very capital intensive and debt heavy, like I said. So, of course, they do manage their debt very well, but interest rates going up does affect them. Of course, it affects their profitability, and so the dividend payout also is affected. There's limited growth. These are not the kind of companies that will become 10x in 5 years. If you're looking at that, please don't look at these companies. Like I said, it's like watching paint dry, It's like as boring as that, watching the stock price move on this, the ticker move on this. And of course, the regulations is another big downer on this. Depending on the government which comes into power locally, federally, it has a huge impact on these companies. And the last thing is green shift. We are trying to move more and more to clean energy, and all these companies are old companies using very old methods of generating power and all that. So it has a huge impact on them, this green shift. So those policies also affect them. And the companies which I wanted to first talk about is NextEra Energy. This is a hybrid play, traditional utility and part renewable energy leader. They're based out of Florida and they're pushing hard into wind and solar. And the yield is almost 2.5, and the dividend has been growing over the decade. So if you're looking for something with a little bit of green exposure and some dividend income, I would say this will be your play. Currently, the stock is trading at $69, and the discounted cash flow, I would say, would put it around 64, and the relative is at 130. The intrinsic value is at 97, so it's around 28% undervalued by these calculations. Historically, the 5-year history, as I always say, if you look at that, it is right now at an attractive range. So if you wanted to deep dive into a utility company and see if it's something that should be in your portfolio, NextEra Energy should be there on your list. The next one which I wanted to hit on is Duke Energy, trading as DUK. They're an old classic regulated energy giant from the southeast. And the yield is about 4.3, which is fabulous. It's a solid balance sheet, reliable cash flow. And they're cleaning up their old coal plants and moving towards gas and renewables. So it's not a high growth stock, but it's like a tank machine, like an army tank in this market crash. So you're well protected and you're able to move along. Duke, the current price is at $115. The discounted cash flow is at 100, and relative is 212. Intrinsic value is 156. Which puts them around 26% undervalued. But if you look at it historically, the last 5 years, maybe you need to wait for a correction because it will be looking unattractive if you're looking at the history of it. So, like I said, you have to make the decision based on your requirement on the dividend yield and, of course, where the price is. Does it make sense? if you look at it purely on intrinsic lens, it is undervalued, but if you're looking historically, maybe you think it's not so attractive. So it is for you to decide after you deep dive into Duke Energy and see if you want to put this into your portfolio. The next one is Southern Company, SO. It's another Southern heavyweight. It's a steady dividend payer. It has a yield of around 4%, and they've invested heavily in nuclear energy. Yes, it is risky, but that is where the world is heading towards with AI. And you saw Meta recently signing agreement, small nuclear power production, because all these IT and AI companies will require this. So that is to keep in mind. So it has always been a favorite among conservative income investors, Southern Company. Right now it's trading at $88. Discounted cash flow puts it at 36. Relative value is at 137. So the intrinsic, which is an average, comes to around 86. So it's about fair price right now. Historically, if you see, it's not at like great price point to enter, but like I said, 4% dividend yield is very good. So worth considering. Next stock which is there in my list is the American Electric Power, AEP. They cover large parts of the Midwest in the US, and they have a dividend yield of over 4%. They're currently modernizing their power grid, and that has been hoping that it will enable them to have some growth. So if you think the rest of them are like old school power companies, this is like a tech, the tech guy in this power company. It's also an old company making power. It's not anything attractive. I'm trying to make it sound attractive. So if you look at it that way, they are a little more cutting edge. They're trading at $101. Discounted cash flow puts them at 56. The relative is at 188 and intrinsic value is at 122. They're around 17% undervalued if you look at these numbers. But like I said, historically speaking, if you look at the 5-year average, maybe you'll want to wait. The next one is Consolidated Edison. This is a New York City utility. One of the most boring companies if you want to talk about utilities. I can say that with admiration, I guess. They've been paying dividends over the last 100 years. So you have a huge track record to see if you're looking at Consolidated Edison. They have a yield of over 4%, so which is about good. In a city that never sleeps, this is a stock will let you sleep very peacefully if you're looking at it in terms of price and growth and everything put together. But they're a great company. Like I said, over 100 years they've been paying steady dividends, which is a great thing to have, in your track record. They're trading at $102. Discounted cash flow puts it at 71. Relative value is at 190 and intrinsic value is 131. So they are 22% undervalued. But again, if you look at it historically, the stock price hasn't really moved anywhere. So, the trade-off is that you get a steady company, you don't go anywhere much in terms of losing capital. You get some dividend in your hand, some pocket money in your hand, which you can take and play on other stocks, I guess. There are two other ones you can call them, optional, if you want to talk some more. Dominion Energy, trading as D, has a yield of 5.5. Only problem is they're recovering from a few missteps that they've taken from 2020. So you'll have to really study this if they're on the right course and the right track, because they are attractive historically and they are intrinsic value if you look at, and price where the stock is, it is trading around 37% under intrinsic value. So Dominion Energy, if you want to, definitely you can look at it. But like I said, they're recovering from some mistakes they've made in the past. You have to make sure that they are on the right track. The next one which you can look at is also Pinnacle West, which is an Arizona-based company, which has a dividend yield of around 4.6, which sometimes is overlooked. They're also trading around 25% undervalued, intrinsic value if you look at. But 5-year average, if you look, maybe you'll find them a bit expensive. But this is how it works. These are not moonshot stocks. They will not give you 10x returns in 5 years. But they are great at giving you dividends. If you're looking for some steady income, some stable income, and peace of mind in these kind of markets, they're great things to over. They're like an old thermos flask. You put hot water inside and it stays hot, as we say in down south India. Anyway, I hope you enjoyed the video. I hope you found it informative and entertaining when I was talking about defensive and utility stocks. It's very different, the landscape in the US compared to what is in India. We do not talk about these power companies in India, so don't get confused. Those of you who are long-time viewers who suddenly saw this video after a long time thinking, Vinod is talking about Defensive stocks in India, meaning utility power companies. No, I'm not talking about Indian market at all. So please, please, please do not get confused and think about jumping into Indian companies. India is a different kettle of fish when it comes to power, utilities, water and gas. And Anand has spoken extensively about this. Maybe I'll talk about this on Instagram, why you should not do this in India, as a follow-up tomorrow. Okay? Hope you enjoyed the video. Hope you had a wonderful day and a wonderful evening and you managed to get some grub down. Nothing else more to say. See you tomorrow from Bangalore again, where I'll try and talk about AI and semiconductors. Not AI, semiconductors and NVIDIA and AMD and all those other goodies which I spoke about at the beginning of the video. I'll do that video tomorrow. Nothing else more to say other than good evening and see you tomorrow with another one. Bye.